Hi, I have seen a lot of people take life insurance policies, but they have got no clue why they have taken that particular insurance policy, because there are different types of life insurance policy and each of them is designed to meet certain financial objectives. So it is important for you to know the different types of life insurance policy and the financial objectives they meet, so that you can align your life insurance policy to your financial objectives and financial goals. In this video, we will talk about different types of life insurance policies. In insurance, basically you pay a small premium to the insurance company. In return, the insurance company gives you an assurance that if you suffer a loss, then they will compensate you for that loss. That is, insurance is taken to cover risk of loss. Now, different types of life insurance policy cover different types of risk. Based on what type of risk a particular life insurance policy is covering, life insurance policies can be classified into following types. The first type of life insurance policy is a pure term insurance plan. Then you have pure endowment plan, then a simple endowment plan which can have two variants, money-back plan or a whole life plan, and then you also have investment linked insurance plan, and finally you have insurance linked annuity plan or a pension plan offered by several insurance companies. Briefly, we will talk about each of these plans. Let's talk about the pure term insurance plan. A pure term insurance plan covers the risk of dying too early. If you are breadwinner of your family, your early death can jeopardize the standard of living of your family. So to cover this risk, you basically take a term insurance plan. In a term insurance plan, if your death happens within the policy term, then your family receives compensation from the insurance company. They receive adequate funds using which they can maintain desired level of standard of living. However, if your death does not happen during the policy term or you survive the policy term, then you do not receive anything in return for the premiums that you have paid. The second type of insurance policy is your pure endowment plan. So a pure endowment plan basically covers the risk of dying too late. Because longer you live, more money you will need for your medical expenses and survival expense. And there is a risk that you might outlive the money that you have. So dying too late is also a risk, a financial risk, which can be covered using a pure endowment plan. So in such type of policy, if you survive the policy term, then on maturity you receive survival benefits or maturity benefits, so that you can cover the risk of dying too late. However, if your death happens within the policy term, that is, you do not survive the policy term, then you do not receive anything in return for the premiums that you have paid. The third type is commonly known as endowment plan. So an endowment plan is actually a combination of pure term plan and a pure endowment plan. That is, it covers both risk of dying too early as well as risk of dying too late. So in such type of policy, if your death happens within the policy term, then to compensate for early death, your family receives sum assured or compensation on your early death. However, if your death does not happen during the policy term and you survive the policy term, then you receive survival benefit on maturity, using which you can cover the risk of dying too late. So in this way, it covers both risk of dying too early as well as risk of dying too late. Now there are two variants to such endowment plan. First is money-back plan, which, as I told you, is a variant of endowment plan. So in such type of policy, if your death happens within the policy term, then just like a normal endowment plan, your family receives compensation on your death. However, if you survive the policy term, that is, your death does not happen during the policy term, then instead of giving you 100% of the survival benefit at one go, they will give you the survival benefit in parts. That is, let's say instead of giving entire 100% at the end of 25th year, they would give you 25% of the total amount to be given each at the end of 10th, 15th, 20th, and then finally at the end of 25th year. So such kind of policy is basically suitable where the cash flows that you receive from the policy meets your financial goals, the cash flow that you need for your financial goals, let's say for higher education of your child, etc. The second variant of endowment plan is a whole life plan. In a whole life plan, your life cover is available for your entire life. So over here, if your death happens within the specified term, that is an early death, then your family receives compensation on your death. However, if your death does not happen during the specified term and you survive the specified term, then you get survival benefit at the time of at the end of the specified term, using which you can cover the risk of dying too late. But the important point over here is, even after receiving the survival benefit, your life cover continues for rest of your life, and whenever you die, the family will receive compensation on your death. So your family will receive compensation irrespective of when you die, early or late. Whenever you die, you leave something or the other for your family, you leave something behind, and that is why such type of plan are typically used as an estate planning tool. The next type of plan is investment linked insurance plan. So over here, these plans are basically called as ULIPs, or unit linked insurance plan. And here, in addition to covering the risk of dying too early or dying too late, such plans also gives an investment opportunity to the policy holders. So over here, the premium of such policies are basically divided into three parts. A part of the premium is used to cover the expenses to manage the policy. Some part of the premium is used to cover the mortality risk, that is risk of dying too early or dying too late, just like a normal endowment plan. But a part of the premium is also invested so that they can generate return on investment for the policy holders. Now this investment can be either in debt funds, that is funds investing in fixed income instruments like government bonds, corporate bonds, debentures, fixed deposits, etc. Or it can be an equity fund, that is funds investing in stock markets related investments. Or you also have the option to choose a fund which is combination of about two funds, that is balance funds, where partly the funds will be invested in debt fund and partly the funds will be invested in equity fund. And finally, you have insurance linked annuity plan. So in an insurance linked annuity plan, you invest a certain amount, usually lump sum, in the policy, and in return you receive a regular cash flow, okay, at a fixed cash flow at fixed interval of time. The interval of time can be monthly, quarterly, semi-annually, yearly, etc. So typically these plans are used for retirement planning, because in retirement phase you need a regular cash flow, because your earned income stops and then you can maintain your standard of living using this fixed cash flow that you receive at regular interval of time. Now there can be two types of such annuity plan. One is called as immediate annuity plan, where on making investments your annuity starts immediately, versus a deferred annuity plan, wherein once you make an investment your annuity starts after a specified period called as deferment period. So again, you can invest during your working life, but you would like to receive your annuity in your retirement phase. So these are the different types of life insurance policies. As you can see, they are designed to meet certain specific financial objectives. So make sure you choose your life insurance policy to match your financial objectives or your financial goals. Thanks for watching.